A warm welcome to the Monday version of the On the Tape podcast. Guy Adami, always joined by Elizabeth Young, Thomas of SoFi, and Dan Nathan. Dan, how are you today?
I'm doing great, Guy Adami. Thanks for asking.
Elizabeth, your Packers of Green Bay are now 2-1 with a backup quarterback. Look at them coaching extravaganza out there in Green Bay.
Yeah, the run game has been good. They started letting him pass the ball, and that's gone well. I mean, 30 points yesterday.
Well,
going great.
Sometimes things defy logic, and we'll get right into it because that's exactly what's going on in the market. Packers defying logic, playing with their backup quarterback. The market, Dan, somewhat defying logic, just sort of on cruise control with an S&P now north of 5,700. I think we're within, 20 S&P points of another all-time high.
Yeah, no, I think we're there, up 20% of the year. But a little housekeeping first, Guy Adami. You had a great conversation last week at the Georgetown Pissarro Center for Financial Markets and Policy with Terry Duffy, CEO and chairman of CME Group and great friend of the pod. So that was a great conversation. Take a listen to that after we're done waxing poetically. Liz, up 20% on the year, S&P 500, 50. I think the prior high, Guy, was it 5670 or something like that? Or we had a close, I guess, above 5,700, but the prior high from about a month ago. All systems go. Liz, you've been on Market Call with us. We've seen you on CNBC. We've been talking about here on the Tape. You've given us some sense of what history suggests for the last rate hike, the period in between the first rate cut. Is this the thing that Guy is speaking about that is defying logic a little bit, that since that cut, which was 50 basis points, there was a lot of debate, whether it was going to be 25 or 50, a lot of debate for the reasons why. But here we are. It seems like it's all systems go for the stock market.
I'll stop short of saying it defies logic in this moment, because right now, what I think, if there is anything that defies logic, it's that people and the market at large has started to really bake in that we've already secured a soft landing. So I'm looking at sector returns year to date. If I looked at these sector returns last week or the week before, it would have showed only defensives and only rate sensitive sectors in that top 5. Now we've got infotech up there in the number 2 spot, communication services up there too. So utilities still leading the pack, but we've obviously got this little catfight between utilities and tech in the top spots, which tells me that the market has pretty much decided soft landing is much more likely than hard landing. That, I think, is a bit premature. Now, to your point about what do we usually see in these environments, the pause period, so the period between the last hike and the first cut, is typically positive for markets. That has been the case this time around as well. We almost had the longest pause ever. We would have gotten there if they waited until November to cut rates. But the fact that the pause has been so long and the fact that the yield curve inversion has gone on for so long would tell you that there is actually a higher risk for more pain on the other side. Part of that is because we've been in such an extended period of a market environment where things have been on this rip-roaring rally, seemingly in the face of other challenges that we just shrug off very easily. Now the market environment has changed. That doesn't mean that it has to be terrible, but it has changed. Rates are dropping. We're more focused on jobs than inflation. The economy has gone from overheated now to cooling. There are things that have changed in the environment, not to mention yield curve inversion. Now, as I say this, at 16.8 basis points, no longer inverted. That's 16.8 basis points positive. That is the highest normal curve that we've had for this cycle.
And I think it's the steepest we've seen in 28 months or something. So, over obviously 2 years. And what's interesting, I read something from Bloomberg, Dan, talking about the market needing a new playbook for this environment. And they basically said, the reason why the Fed typically lowers borrowing costs, lowers rates, is to fight off a weakening economy or to boost one that's already sunk into a recession. And neither of those things are seemingly happening right now. Right now, the economy is, again, growing. Equities are at all-time highs, as we said. Corporate earnings are expected to keep expanding. So there's really no necessarily playbook for this unless you want to sort of go to the 95, 96 analog, which I think a lot of people are trying to make that comparison, Dan.
Yeah, and again, we've debated this again and again and again. Liz just said this, that, the market's pricing in a soft landing. I think a lot of optimists thought that that's what we're going to have. There were a few that thought we were having no landing. I don't remember what that meant, but the idea of a hard landing, it just seems out of character right now because we really can't put our finger on what that might be. The idea that rate cuts coming too fast and furious might restoke inflation. Okay, that makes sense to me, but not at the moment, the way that we keep seeing the readings for inflation coming down and the Fed's confidence. And I guess you don't have to place a lot of stock in the Fed's confidence. They historically are not any better than any of us as far as forecasting, what's going to happen in the economy, despite all the data that they have. Liz, I know PCE is something that you're focused on this week. That guy is the Fed's most favored inflation reading, by the way. So again, do we need a new playbook? Maybe. I just think people who are long stocks seem to be pretty happy about it. They're also happy about the fact that rates are coming down. And, when you think about that in economic terms, it should help consumers, right? I mean, like that's the only thing I think that a lot of folks who look at the contribution of the consumer for GDP and what that might mean for S&P 500 earnings, it gives them greater confidence that we're going to hit double-digit growth this year for 2024 and that we're going to get double-digit growth again in 2025, Liz. So again, at some point, it does come down to expectations for earnings, and that 2025 number has not come down all year long.
That's right. And look, stocks do over the long term follow fundamentals. So in the near term, they don't always trade that way and it doesn't always make rational sense. But over the long term, stocks should follow fundamentals. If earnings growth and margins continue to stay strong or even expand, stock prices or the companies that have managed those margins well should follow that expansion. What we've talked about, and I believe we covered this last week, is just the math of where the PE multiples are right now. And remembering that PE is a product of two things, the price and the earnings. So if earnings continue to go up and price stays about the same, the PE multiple will come down and maybe look more rational for this environment. If the price comes down and the E stays the same, the PE multiple will go down as well, obviously. I think all three of us here, looking at a PE of 21, 22 times on the S&P for forward earnings, can say that feels a bit high. Now, is it outrageous? Is it 2000 outrageous? No, but it's a bit high. And is there a lot of room for it to run further? It doesn't feel like there is, because if it runs further, it's going to feel like it's knocking on outrageous's door. So we probably need multiples to come in a little bit. I would like to see that happen with the earnings going up rather than the price just continuing to go up unabated.
Now, and the other thing predicated on all of that, historically, well, not historically, but definitely pushing towards the upper end of the band in terms of valuations is the fact that I think the market is pricing at about 14.5%, 15% earnings growth, Dan, which, I'm hard pressed to figure out how we're going to get there. So, we're in an environment right now where there's a lot of optimism around earnings growth, and there's obviously optimism in terms of the valuations people are willing to pay. And the other thing, you mentioned the rates are coming down, but again, this is not a trend yet. But since the Fed announced their rate cut, TLT has actually gone down. So yields have actually gone up in the back end. And that speaks to what Elizabeth was talking about earlier, the fact that the yield curve is now 17 or so basis points steep, the most we've seen in basically 2.5 years or so. So, people will champion the fact that rates are going lower, except if you really look, maybe not so much, coupled with the fact that even if rates do go lower, it's not going to move the needle in terms of credit card rates and some of the other things that are out there. So it goes back to something we've talked about for a long time, Dan. Be careful what you wish for, because you just might get it.
Yeah, I'll just add one thing about that, though. So if rates were to come down, let's say faster than some people think, and, last week and over the weekend, there was lots of Fed heads just talking about the pace of cuts, right? And there was a lot of differing views on that. But if you lower rates enough, then you push people out the curve, from a risk-taking standpoint. That's exactly what happened in the back half of 2020 and all of 2021. And when the Fed basically said, we have to kind of take some air out of this risk asset bubble, out of an economy that was reopening and overheating, that's when the stock market obviously really got hit. But think about this. The 2022 hikes, right? The bulk of them really came mid that year. The stock market bottomed in October. You know what I mean? A lot of the damage, really was done in the first half of that year. So again, I have no idea what's going to happen with these cuts. And I think the debate whether they can actually put up a mission accomplished sign or, right, and kind of work through that soft landing scenario and avoid a recession altogether, or they're doing it because there's something that they see on the employment front that is not particularly great, or some of the data under the surface is weakening. Well, earnings estimates for next year are going to be the last thing that actually show that, right? Like, does that make some sense? Because analysts are often, and strategists are often very, late to kind of lowering those sorts of estimates. They want to keep them intact, Liz. Does that make some sense? Because you're going to have to take the cues, I think, from the market and from sentiment. And 21 times, our main man Butters over there at FactSet, he's, I think on a weekly basis we can kind of check in on the earnings insight. They're putting this out also on their Twitter. They'll give it 21 times forward. It's like, versus the 10-year, the 5-year average. I think they're high teens. I think the 5-year average is about 19 and the 10-year is about 17 and a half. And when you think about that, so we're not that extended, because if the top 10 stocks in the S&P 500 are trading at a, 30 multiple or high 20s or something like that, that means the 490 below it are trading probably in line with historical averages, Liz. So again, the worry is that those names that have been powered by the secular shift of generative AI, before they've seen the revenue and the earnings from it, they may take a pause at some point. And that's the thing then you got to worry about a little bit, because if the high end and the big contributors to the S&P 500 earnings are going to come in, then you got to worry a little bit about the 490, I think.
Yeah, you need the rest of the index to keep up. I want to make a point of clarification for any of our listeners who don't understand this. Sometimes we talk about long duration and short duration, both in bonds and in equities. I think for bonds, it's been pretty self-explanatory. But now this is an environment where you might start hearing more about shorter duration on the stock side and longer duration on the stock side. What we mean by that is you've got short duration sectors, things like utilities, consumer staples, dividend payers, that it's more like a bird in the hand type of argument. Long duration sectors in the equity market are things that are growthier. You're looking at them for growth prospects over the long term. They don't typically pay dividends. So a lot of those stocks are going to fall into infotech and communication. So the rally that we've seen recently in these technology names is exactly what Dan just said about pushing risk out into longer duration equity names. Okay. So to answer the question earlier, I talk about this all the time, the sequence of events that typically occurs. Dan, you asked about analysts probably not lowering their earnings expectations for next year until later if something happens. The sequence of events typically goes, the market goes down first, then earnings go down, then the economy. So we're probably not going to see analysts lower earnings expectations unless something happens to stock prices. Because right now, the way sentiment is moving and the way that they can extrapolate out what revenue growth might look like, what margin expansion might look like, still feels pretty positive, especially given the fact that the consumer is still spending. There's still at least some enthusiasm in the AI theme, and there continues to be power behind it and buying power behind it. So yeah, I don't think that we're going to see earnings expectations come down anytime soon, especially in the midst of a quarter where we're still expecting perhaps above 2% GDP growth. So I wouldn't wait for that to happen as a decision factor about stocks. I think that this is a time when you want to make sure the portfolio is positioned for a different environment, and that environment being a steepening yield curve and lower rates, at least on the short end of the curve.
Yeah, really quickly, I saw this. There was a downgrade of Microsoft, which you don't see too frequently, I think by a company called D.A. Davidson guy. I don't know this D.A. Davidson. I've never heard of this D.A. Davidson, but I will tell you, like, it's kind of interesting. Sometimes you'll see second, third tier brokerage firms try to get ahead of stuff like this. And I think it's related to the uptake as far as, their co-pilots and the sort of stuff that they're trying to tout as the new paradigm in computing, guy.
So what Dan was doing there, Elizabeth, because I know you sort of went over your head, and I apologize. He was channeling his Godfather 2, and that, of course, is a scene when Connie Corleone goes to see Michael in Lake Tahoe, and she brings her then fiance, tells Michael she wants to marry this Merle, and Michael says, "I don't know this Merle. I don't know how he makes a living. You're going to tell Merle." By the way, that's with him sitting right there. that, this is not going to happen. Anyway, I digress for a second. What I'll say to you about the Microsoft, and we've talked about it. I mean, I've said this for years on Fast Money. I think Microsoft is one of the five, if not one of the three most important companies in the world, and they've done a remarkable job. And if you go back and look, much like Intel, and we'll talk about that in a second. I mean, this was a extraordinarily large technology company that had lost their way, but obviously sort of figured it out and sort of re-emerged as a much different company. I don't know, 7, 8, 9 or so years ago, and you've seen the fruits of their labor. But with that said, the markets provided them a valuation that I don't think makes a lot of sense. And I haven't looked today, but you're probably talking about a company that's trading around 31 times next year's numbers, which is historically very expensive. It doesn't mean it's not a great company, but the market's baking in a lot of the cake. So again, I've heard of D.A. Davidson. I think I do know what he and she does for a living. And I admire companies that try to get ahead of something. So we'll see how the entire thing plays out. And by the way, it's not going to be that long before we start to hear from companies like Microsoft.
Yeah, and just to be clear, so this fiscal year is trading about 33 times expected EPS growth of like 13%, 15% sales growth. All makes sense. I mean, we're basically talking about a company expected to grow earnings and sales for the next few years. At least this is what consensus looks like per FactSet, in the low to mid teens. Great. It trades at 33 times this year, 28 and a half times next. Flat-ish margins. They've been coming down a little bit because of this spend and the like. But, there's 65 buy ratings on the stock and 4 holds. This is the case for the Mag 7 other than Apple and Tesla. Can we talk? We got to talk about Intel. We got to talk about chips. But Liz, are there some sectors in tech, that you're worried about in this rate cutting environment, just going back to the long duration, short duration equity thing? Because I look at my screens and I still see XLU utilities as the best performing sector in the entire S&P 500, up nearly 30% on the year, again, versus an S&P that's up about 20% or so. So how do you make heads or tails of some of these defensive sectors that are still performing very well with an S&P at all-time highs?
Well, we have to remember that Utes trade, and I'm using that on purpose, Guy, just to get under your skin. That Utes trade, part of it is driven by the fact that people are looking at it as an adjacent trade to AI. So I don't know exactly what the makeup would be, what the proportions would be that AI drove some of those returns versus just a defensive nature and a defensive stance and dividend paying nature of those stocks. If we give up a lot in the AI trade, so if you see semiconductors fall off a cliff, let's say something happens, you probably see utilities give a little bit back as well, because that adjacent trade will have to let some steam out. Now, if you look at industry groups within tech, so we've got 3 industry groups as according to GICS. We've got semiconductors, we've got technology, hardware, and equipment, and we've got software and services. Semiconductors handily outperforming the other 2 industry groups, up 60% on the year. Software and services up only 16%. Now, in any normal year, I'll take 16% in any industry group, but the spread here is really, really wide. So to answer the question about is there anything in particular that I'm worried about in this environment, I would say a spread like that is what worries me. And you look at that top group of semiconductors up 60%, not because something is wrong with the group, but because they've had such a good run that when you hit volatility, as we know, the easiest stuff to sell is the stuff that's in the green in your account and those most liquid names. So, and we've seen it already a couple times this year. When we hit the skids, you see those big names give back a lot more than the broader market. So I'd be careful there and make sure that you're not overexposed, especially going through the rest of September and October in an election year. We're prone to volatility. Just make sure that you're not overly concentrated.
Yeah, and real quick, I'm glad you mentioned the utilities. Obviously, you were going a little my cousin Vinny there, which is fine. I like what you did, but the XLU, I think today or last week, made an all-time high. We got through the levels we last saw, I think, in the summer of 2022. And I think Elizabeth is right to point out, I think it's a combination. It's both defensive in nature, one, which sort of makes sense, but it's also a bit of a growth story too, which is somewhat counterintuitive based on everything that's going on in AI. And if you look at some of these names, like a Vistra Energy, for example, but even a Next Era, which I think is 14% of the XLU, and a Southern Company and a Duke Energy. I mean, all these companies have been the beneficiaries of sort of this two-pronged attack. So the question, I guess one has to ask themselves, if the AI sort of adjacent trade runs out of steam, what's going to happen to the utilities? I think it's a really fascinating conversation, Dan.
Yeah, no doubt. We've heard a lot of different scenarios where, Microsoft's doing a deal with literally a nuclear reacting company that's coming back
Green Mile
online.
Island, baby.
I mean, there seems to be a frenzy about this. But if you believe that Microsoft, Google, Amazon are overbuilding capacity, for their cloud businesses, at some point you're going to see a pullback in demand, and then you're going to see these valuations come down. Guy, we got to hit this story. I think it was late Friday afternoon that Qualcomm had approached Intel as a possible merger, nearly double the enterprise value of Intel, which, is just crazy to think about. AMD, which was always the ugly redheaded stepchild compared to Intel. When I say always, leading up to just about 5-6 years ago, they've taken a lot of share in data center. They obviously are positioning themselves to, compete with NVIDIA with high-end GPUs that go into these servers, that go into the data centers, that train the AM models. You guys get that. But, that deal, and we talked about it a little bit on Fast Money on Friday afternoon. It would make some sense to me that it would be the largest, technology deal, I guess, ever. But there's not a lot of overlap between these two companies. And you think about Qualcomm, which is squarely positioned within the mobile space. Intel is nowhere there, right? So they are, they've lost share in the data center. They want to get towards this advanced computing for GPUs and the like here, and they're nowhere there. But they have taken, or they will take, a lot of money from the U.S. government, under the CHIPS Act. They just did a deal, I think, with Amazon to develop chips. There's a lot of money coming into this company. It would make sense to me if the government would like to have a second source, or have a source, if they're thinking about diversifying supply chains and they really are giving them billions and billions of dollars to build fabs here. It would make perfect sense under either administration, that this deal would get, approved in some way, shape, or form. Thoughts there, Guy, and maybe what this thing should trade for also.
Well, I mean, first of all, I think this was talked about a few years ago, I think, Qualcomm-Intel type of situation. You thought it made sense. I mean, I'm not a huge fan, but all right, let's play it out. I mean, if this were to take place, my sense is this would have to be a deal north of $125, $130 billion or so, I would think. And then you'd still need, I guess, board approval and shareholder approval, which, I'm not sure necessarily happens. Throw on top of that, whether or not it's going to get through, it's going to pass muster in terms of all some of the cases, non-competitive, and all these mergers that are seemingly being dinged on the governmental side of things. So I'm not sure it happens, number one. I don't know where it came out of, but in terms of the news around Intel recently, you mentioned those three, and then today we're seeing that Apollo is, throwing some money in the Intel camp as well. All of that is great, but I look at a stock, Dan, that if you want to play it from the long side, I would understand that for maybe a bounce back up to sort of 26 and a half, 27. But one would think, given the drawdown in the shares over the last few years, this news flow over the last week, coupled with the broader market at an all-time high, one would have thought Intel would trade a lot better than it has. And maybe it's just the beginning of something.
Yeah, Liz, we talk about this. I mean, at least I do. You usually see like big mega mergers, in and around euphoria in markets here. I don't know if this stock market feels euphoric right now. It does, I think, in a handful of names. It does, like, as we said, in some sectors that don't make a lot of sense to us. But here's one player that is just down and out. And when you have one of the largest private equity companies trying to put a bottom in this thing, you have a embattled CEO, right, who we could have all made the argument, a week or two ago that he should be out. We probably did make that argument. He's been very unsuccessful. The stock's trading at 10-year lows. You say to yourself, well, this one, I mean, to me, it does make some sense. I don't see a lot of overlap. Just give us a sense when you start seeing these sorts of headlines in general. You don't have to opine on this thing. None of us know anything what's going to happen. Bullish, bearish, indifferent.
So this is obviously an isolated situation, and I don't want to paint with a broad brush and say that this is going on a lot around a lot of sectors. But there are two different types of merger transactions or acquisition transactions. There are strategic M&A transactions, and there are financial M&A transactions. What you typically see at the top of euphoria are things that companies will spin as strategic M&A. Now, you see that happen. There's usually this uptick in activity. And then you get to a point, if you're really euphoric in the market, where companies think that they're worth a lot more than they really are, and nobody wants to pay for it anymore. And then you get this pause in M&A activity. This, because Intel is embattled, because it's been struggling, probably gets looked at as more of a financial M&A transaction. Now, if we had a wave of financial M&A, which trust me, we'd hear about, we would feel that it was happening across sectors. That is much more clearly an indication of markets in distress, the economy in distress, and that's companies being saved basically before filing for bankruptcy. That is not happening broadly, but it is definitely something that informs the sentiment around a market environment.
This one feels like a little both strategic and also financial. And especially when you see a PE company like Apollo, they would easily participate in some sort of merger, you know what I mean? In some ways, because it works out for them. You get to cut a lot of costs. There's probably a lot of overlap, but there's not a lot of overlap from a product standpoint. Also, I don't know if you guys have been reading about this. I mean, the right has been very critical of Lina Khan. She is the head of the FTC, and there's been some rumblings that, let's say, the Harris campaign might be moving away from her, which would basically signal one way or another. She's been really aggressive on regulatory stuff, so that might kind of open the door for some deals like this. So we'll see. Guy, it's interesting also that Qualcomm has massively underperformed the SMH too. So this is a company that has been sitting out much of the AI rally. It's down a lot over the last few months or so. It seemed like everything was participating at some point. I got to talk about this, okay? And I want to get your take, Guy. And I'm not trying to be snarky too. This is about the Apple, right? So on Friday, Apple released this 16 and the 16 Pro. The whole marketing of this thing, which I think is massively disingenuous, and I've felt this way since June 10th, Apple Intelligence. That's the thing. This is why you're going to upgrade. Well, I upgraded from a 15. And when I tell you it is the same exact phone with none of the capabilities that the company marketed. Now, I knew that was going to happen. I always get these things. I want to see what the whiz-bangy, sorts of features are. I'm a huge seller of this whole notion of a huge upgrade cycle, especially when you launch a phone and it doesn't have the things that you're advertising for. So thoughts here, Guy, because this stock has held in here except for the fact that it's up in line with the NASDAQ. It's not outperforming like many of these names associated with this Gen AI trade.
Yeah, the June 10th day is where everybody's going to go back and look at. And then obviously the move from 193 up to an all-time high of about 237 that I think we saw in the middle of July. Subsequent sell-off like everything else in August. So, here's my take. Gene Munster has said it's sort of this generational thing in terms of the upgrade cycle. He's extraordinarily bullish for a myriad of different reasons. I think the bull case is around services. What does this mean to the services line in Apple's reports? And the last quarter, Dan, and you know this a lot better than I do, but I think services are now 25% of overall revenue, which I think is the high water mark. And I think the enthusiasts will say that's going to continue to grow, which is why Apple is deserved of this premium valuation. And if it continues to grow against a backdrop of reacceleration in revenue growth and margins which had flatlined that are starting to show some signs of life, you can sort of wrap your head around this valuation and understanding they can grow into it. I think that's sort of the bull case. I think the bear case is, people are going to be disappointed by this upgrade cycle. It's an expensive stock in this environment. And obviously, geopolitically and what's going on in China is still a tremendous headwind. So that's the rub right now. But right now, at least for Apple, the stock, bulls are winning.
Yeah, Liz, really interesting. And we were just talking about the S&P all-time highs here. The NDX, the NASDAQ 100, it topped out about a month ago, just below 20,000. Here we are again. The all-time high was probably, 5% or so. It's still off those highs. So what does that tell you? It tells you that some of those huge contributors, right, to the NDX, the top 10 make up, 50% of the weight. Is it interesting to you that the NDX is not back towards those highs and it's kind of lagging? Does that say anything to you about where we are at this stage of the rally? And I know we started out the conversation here about long duration, short duration, or whatever. If it continues to underperform, that gives me less confidence in too much further upside in the broad equity market.
Well, it would give you less confidence in further upside, at least for me. Gives me less confidence in further upside in the tech complex and the stuff that has driven us to this point. What bulls would tell you is that it's a perfect illustration of a broadening out in the market and other sectors that are coming in to carry their weight. So if we look at even over the prior 3-month period, I'm looking at the S&P here. But if we look at the prior 3-month period, top 3 sectors are real estate, utes, and financials, and then industrials is in the number 4 spot. So if you're in the soft landing camp and you believe that some of these manufacturing numbers that we're getting economic data wise are going to somehow resurge, pick back up, then you would want to buy cyclicals and you would be hopeful that cyclical sectors, not tech, not communications, not the tech related consumer discretionary stuff, you would hope that these cyclical sectors like industrials, financials, materials would pick back up and carry their weight. The market seems to be hopeful that that will occur. We would need that to actually come through in the results. So if the NASDAQ 100 struggles, I think maybe the crux of the question is, can the rest of the market do okay without the NASDAQ 100? I think it can, but it's harder. It's heavier weight to carry, and it's more sectors that have to come in and carry that weight because tech is such a big weight in all of the indices. So you're going to need to see some of these smaller sectors come in and win at the same time.
Before we 5,000, a couple of earnings this week that have caught my attention. We have Micron, the mighty Micron, as they used to say, MU on Wednesday, Costco on Thursday. Dan, I'll start with you. Micron, which I believe made an all-time high as recently as June of this year, about 157 or so dollars, is now trading, either side of $90 or so. So it's had a pretty precipitous decline. If you go back and look, what's I think fascinating about this, it's completely round trip the move from the spring of this year, obviously into the summer, and here we are again. So is Micron important? Because I think, again, Micron is one of these AI adjacent names that everybody got excited about into the summer, seemingly losing some steam.
Yeah, I mean, I think from a sentiment standpoint, we talked about Dell, Supermicro, Micron. Some of these names outside of the hyperscalers, outside of Microsoft, which was one of the first companies to really demonstrate a use case as far as their productivity services or suite of services that they have, or Google across a lot of their services as they integrated Gemini. We started seeing some of these other companies join the party, right? So obviously, NVIDIA was the big name. There was some excitement about an AMD being able to compete with them. That's really never materialized. Then you had memory started to be a big component of this, because if you're going to train these models and you have these high performance chips, you're going to need more memory. And then it was about the servers. That was Dell and Supermicro, right? And so again, we've seen some of the pieces of this puzzle kind of go by the wayside. And, the stock market is not always a great lens to think about fundamentals and secular shifts. But right here, the narrowing of this trade is the problem, right? And so when you have things like Micron that people were really excited about in June, and then you see it sell off 40%, it makes you start to question what sort of legs this trade has right now. Because the folks that are making these decisions about how to play this secular shift in the stock market here and now, they're really good at what they do, right? They followed these sectors, over different cycles. They have tons of data. They talk to these companies. You know what I mean? Like, they have a good sense. So the fact is, the only leg standing of this whatever trade is NVIDIA and a couple of the hyperscalers. So to me, I think it's important. I'm definitely really interested to hear what they have to say. And it's not only what they have to say, it's how the market responds to it, how investors respond to it, whether the guidance was enough. Does it give them greater confidence, right, about what the next year looks like for the build out of these data centers and the like here? So that's my 2 cents. I think it's kind of interesting. I think it's a hard press, to be honest with you, right here, guys. So your quick sense on where the market or where investors are in the name after this huge pullback.
Well, it feels as though a lot of people have lost the enthusiasm that they had. So the setup to me is eerily reminiscent of this sort of some of the setups we've seen before, where you just said it's a hard press. What you're saying is it's a hard press to think there's going to be continued downside here. So, I think the optimism that was all around the stock in the summer is completely sort of abated. And I think the risk is probably to the upside here. But I'll tell you though, if they disappoint, again, I think it's an important tell as to the health of this entire AI trade. So we'll see. I'm equally interested in hearing what they say and then the subsequent price action. Elizabeth, you've heard me say this before, so indulge me for a second, but there might be some new listeners and viewers to the On the Tape podcast. But sometimes you see wishful thinking play out right before your very eyes, and it comes in the form, for me, of going to a Costco and watching some 85-year-old dude in his little steam buggy there with the electric cart buy 60 rolls of toilet paper. I mean, that is aggressive. But with that said, it's clearly working at Costco because you have a stock once again within an earshot of an all-time high. So Costco on Thursday, I'm not looking to play stock market in terms of the name, a stock that's probably trading 50 times next year's numbers. But is it a tell in terms of what's going on? Will it sort of reaffirm that whole Walmart narrative?
It should. I think it should reaffirm the Walmart narrative. If it flies in the face of the Walmart narrative, then you have to scratch your head about it. Now, obviously, I don't look at individual names from a recommendation standpoint, but I do look at bellwether names in the sectors, and Costco is definitely a bellwether name in the sector. Now, if we remember, the story from Walmart was that things were still going well, consumers were still spending. What they benefited from was some of the price rollbacks that they did. And they noticed that consumers were spending more. So their volume went up, their revenue went up, but in the areas where they had rolled back prices. I think that's pretty intuitive in an environment where everybody knows inflation readings have come down. Therefore, consumers go to a store and expect that prices will come down. Now, we know that the math of that is not really working that way. Inflation has continued to grow, so prices shouldn't actually come down, but people are expecting them to, which means consumers are more price sensitive than they used to be. Costco should benefit from that. What we'd want to hear is the same type of story. This is a slow shift, though, in consumer behavior. Now you've got consumers that are not only have they changed some of their buying behavior, but they're spending more money on stuff that looks cheaper or is helping them manage their budgets better. So I would expect that this confirms the Walmart story. Guy, as you mentioned, the stock today up a little bit less than 1%, but up almost 40% year to date. And that's a big move for a staples company.
Yeah, Guy, really quickly, if you just look at the chart, I mean, it is a beautiful chart. It's bottom left, upper right. If you're just looking at the 1 year, it was trading 550 last fall, and here we are, above $900 on two situations here, March and also July. The stock had 11% sell-off, so you see this really nice, well-defined uptrend here. And again, you're seeing this thing base a little bit around $900. So a beat and raise at this valuation, it really comes down to how much, right? And so I know a lot of people point towards the recurring revenue that they have from their membership. I think it's mid to low single digits at best. And you could say to me, does that warrant, that sort of premium multiple to a Walmart or something like that just because you have that recurring? I think not. So I think risk to the downside over like a week or two on not fantastic guidance, you probably have a move back towards 850, and that's probably a decent level to kind of reload on the long side, Guy.
If you look, we've seen type of move like that before in terms of some of the sell-offs post earnings, but within a couple of weeks, at least for the last few years, I mean, those sell-offs seemingly have been bought with both hands by traders and investors alike. Before we get out of here, I think it's important for folks, if you don't subscribe to our YouTube channel, Risk Reversal, I mean, what are they doing, Dan, right?
What are they doing?
And, you should, what do they call it when you smash the like button? Is that a thing?
Yeah, you like it, you follow it, you rate it, you review it, you share it with your friends. That's how people find the show. That's how you can help us out because we think we're doing a good job over here. We'd like to hear more people hear and watch what we do.
Well, I think that's accurate. But for the fact that Elizabeth Young Thomas joins us, I'm hard pressed to believe we'd have half as many followers. So it's always a joy to see you on these Mondays. We will see you again, unless you're traveling and it's unbeknownst to me. We will see you on Wednesday.
I'll be here on Wednesday. Happy Monday, everybody.